Okay, so let me start with the question. What is the single most relevant customer cohort for Bitcoin right now?
That is a fascinating way to open, because the popular answer, the one we all hear, it's so fixed on size, on sophistication.
Exactly. I mean, we spend all our time analyzing institutional adoption, right? The big family offices, the slow, deliberate movements of sovereign wealth funds.
That's the narrative.
Yeah, you read the headlines and you're convinced the answer has to be, strategic sovereign reserves or these giant institutional IRAs and ROTs, the trillions that are maybe finally allocating one tiny percentage. Logic just screams, follow the big money.
Well, logic often points to the easiest path, sure. But as the sources we're looking at today reveal, sometimes the most powerful force in finance isn't big, it's behavioral. It's about displacing a consistent and, frankly, an underestimated cash flow.
So let's throw that logic out for a second. What if the key isn't the strategist or the central banker? What if the most catalytic cohort for Bitcoin is the lottery ticket buyer?
No, I know. On the surface, it sounds crazy. We're talking about people spending $5, $10, maybe 20 every single week.
Tiny amounts.
Tiny amounts, and this is the key, with absolutely zero realistic expectation of a return. That money is already budgeted as entertainment, as a consumption good.
And that right there is why it's so incredibly potent. We're going to make a claim today, a bold one, but a mathematically justifiable one. Bitcoin is the biggest lottery of them all, but with one crucial difference.
What's that?
We promise every single player a massive return, provided they just commit to the plan.
And that commitment, that simple behavioral shift, is what creates this profound system shock, especially for the states that are, running that lottery system. The sources describe it perfectly.
I love this quote.
It paints this stunning picture. They call it a plan where birds can literally fly away with the entire net cast to track them.
And that net, of course, is the state revenue, the money they get from all those lottery sales.
Let's put a number on that. A really, really big number.
Let this sink in for a minute. U.S. lottery sales annually are $113.3 billion.
Say that again, just so it lands.
$113.3 billion. B. That's not a rounding error in the consumer economy?
It's not. It's bigger than what combined U.S. spending on all streaming services, all movie tickets, and all concert tickets.
Combined. We are talking about one of the largest, most consistent retail cash flows in the entire country. And we're going to model what happens when you just divert it.
And the beauty of this cohort from a capital rotation perspective is their psychology. They're already committed to losing the money.
Yes, they've already budgeted for a 100% loss. There's no expectation of capital preservation, just this tiny flicker of hope for a near impossible win.
But when you redirect that impulse, that small weekly bet, and you turn it into saving the world's hardest, most scarce asset, you get what the sources call a good karma scenario.
I love that framing.
It's powerful, right? You're fundamentally changing an impulsive spender into a consistent saver. And they're not betting on impossible odds anymore. They're betting on the programmatic scarcity of an asset that's designed to appreciate.
And, critically, this is the ultimate act of decentralization. It puts the asset where it belongs.
In the hands of ordinary people.
Yes. It decentralizes wealth accumulation away from the institutions and distributes it across the population.
But we have to prove the promise, right?
Yeah.
You said a 10x return. We have to show the math.
We do, and we're going to. Let's use the report's aggressive, but, as we'll see, fully justified scenario. If the price today is, say, $90,000, 10x is $900,000.
Okay.
The sources show an optimistic projection reaching $765,000, which is close enough to justify that 10x claim in the extreme case. And this is within 1 year. 1 year. If every lottery player just shifted their behavior.
The structural dynamics of the Bitcoin market are just so brittle. They're so constrained that under that kind of sustained, relentless demand, these figures stop being fantasy. They become an inevitable mechanical outcome.
So here's our call to action right now to every HO dealer, every influencer, everyone who wants Bitcoin to move beyond the slow grind of corporate treasuries or sovereign reserves.
Stop waiting for the banks.
Stop waiting for governments. Instead, seek help from the cohort that already knows how to bet, the lottery players. If this shift happens, you will see Bitcoin's market cap beat gold's within a single year.
This deep dive is all about that. The math, the behavioral revolution, and the immense structural and political fallout of this single massive capital rotation.
I'm Satoshi.
And I'm Satoshi.
Welcome, everyone, to the deep dive. We are just so grateful for the amazing response we've been getting. And speaking of our own call to action, we really want to make the visual side of this content more vivid. We're dealing with complex mathematical models, and there's, only so much you can communicate with just words.
Yeah, I mean, a visual component to understanding this structural shock, to actually see the order book depth just vanish in real time, that would be incredibly powerful.
And as you know, our constraint, we need to hit 1,000 subscribers to get the funding for the Mosaic AI video editor. Our marketing team is obsessed with it. They think they found the holy grail of AI editors for this kind of complex stuff. So all we need is your help. Please subscribe if you haven't, and share this deep dive in your WhatsApp groups or wherever you geek out about Bitcoin, finance, all of it.
We're really committed to making this clearer and more accessible, and that just means we need better tools.
Absolutely. And also, please let us know in the comments if you know of a fully automated AI video editor you think is better than Mosaic. You can check it out at mosaic.sos. Now, let's get into the forensic accounting of that $113 billion. Okay, let's unpack this. The whole thesis, it really rests on the size and, maybe more importantly, the consistency of this capital.
What's fascinating here isn't just the big number, it's how reliable it is. According to NASPL, the Lottery Association, gross U.S. sales for fiscal year 2024 hit that $113.3 billion. This isn't speculative capital. It's guaranteed, sticky retail cash flow.
$113 billion. We said it's bigger than streaming, movies, and concerts combined. I think that comparison really helps ground it for people. This isn't some niche activity. It's a financial ritual for millions.
A very persistent feature of the consumer landscape. And critically, it's not a dying industry. The sources point to this robust growth. Sales jumped from around $80 billion in 2020 to over $113 billion in 2024.
That's a huge jump. We're talking about a compound growth rate that's nearly 10% year over year. This spending is deeply inelastic. It doesn't dry up in a recession.
Arguably, people are more likely to buy a ticket when things are tight. That hope of winning, it gets amplified. It's a constant.
Which leads us right to the source materials. Pretty blunt description of the whole system. They call it a highly optimized, date-sponsored extraction engine.
It's ruthless, designed for efficiency and predictability, just funneling dollars from households into state budgets.
But this is where we have to be really precise. We're talking about $113 billion in gross sales. But not all of that is permanently lost to the consumer, right? We have to distinguish that from net liquidity.
That is the crucial accounting point. Absolutely. Yeah. If you look at what some call the fresh fiat model, the actual wealth that's permanently removed from the consumer class, it's closer to, say, $39 or $40 billion. The rest is just churned through the system.
Walk us through that churn. Why is the gross number so much higher than the net loss?
It's the churn mechanism, and it's kind of genius in its design. It's all about maximizing volume and building habits. About 60 to 70% of all the gross revenue is immediately paid back to players as prizes.
Small prizes, mostly.
Exactly. We see states like Virginia returning over 73%, Massachusetts over 69%.
So if I win, say, $100, the whole system is designed to stop me from actually banking that money. It wants me to walk right back to the counter and buy 100 more scratch-offs.
Precisely. That small win, it never really leaves the ecosystem. It's immediately re-wagered, keeping the money in constant motion. The system has this incredible consumption velocity, but zero savings velocity for the player. It's a very tight loop.
Okay, so this brings up a critical point about the simulation. And I want to challenge this a bit. If only $40 billion is really fresh money being lost, why does the simulation use the full $113 billion? Aren't we inflating the potential impact by more than double?
That's a great challenge, and it gets to the heart of what behavioral displacement means. The simulation isn't modeling the net loss. It's modeling the conversion of the entire budgeted flow. Everything dedicated to speculation and hope is now being redirected into savings.
Oh, okay. So we're modeling the maximum possible shift in the consumer's budget. If they start buying the ticket, the entire $113 billion, the original money plus all the rewagered prizes, is retained and diverted.
You got it. We are converting consumption velocity into savings velocity. The money that would have been prizes and immediately turned back in is instead accumulated. It's retained as an appreciating asset. So the $113 billion represents the total, reliable, aggregate demand for hope that's being rerouted into Bitcoin.
That reframing makes the number just inescapable. And when you break it down by day, the impact becomes so much clearer. That total annual flow, it translates to about $310 million in new buying pressure daily.
And that's the number that should honestly terrify any financial modeler in this space. It's a capital tsunami, and it's constant. 310 million day in, day out, regardless of whether Bitcoin just hit a new all-time high or is in a 50% drawdown. Institutional bids come and go. This retail flow is perpetual.
It's a flow that never stops. And that constant, relentless nature is what forces us to look at the destination, at the structurally constrained Bitcoin market. So shifting gears to market structure, that $310 million daily flow is about to smash into one of the most constrained assets in history. Let's talk about the vessel itself.
If we connect this to the bigger picture, I mean, Bitcoin's entire value proposition is its absolute unchangeable scarcity. A fixed supply cap of around 21 million coins with, 19.95 million circulating now? This inelasticity, it's the structural core of the whole thing.
And the timing here is so critical because we're talking about a post-2024 halving world. The new supply coming online is at its lowest point ever relative to any historical demand.
Let's just quantify that mismatch because it is colossal. After the halving, the daily issuance of new Bitcoin, the supply from miner, is just 450 BTC per day.
450.
Yep. And if we use our baseline price of $90,000, the dollar value of that new supply is a mere $40.5 million a day.
And our daily retail bid, just from this one cohort in the U.S., is 310 million.
Which means the lottery inflow is a staggering 7.6 times larger than the daily dollar value of all the new supply entering the market. This is the structural crisis in plain sight.
So the market can't possibly satisfy this demand with new coins. The implication is profound. The market has to find willing sellers among existing holders, the HO dealers, to satisfy 7.6 times the miner's daily production every single day, just to keep the price from moving.
And we know, thanks to all the on-chain data from places like Glassnode and Fidelity, that those sellers are getting rarer and rarer. They estimate that a huge percentage of the existing supply, often over 60%, is held by long-term holders. It's locked away. It's illiquid. It's not moving.
Which means the overall market cap, that huge number we see on the news, is really misleading. It looks deep, but the actual tradable float available to soak up that $310 million daily bid is tiny.
Absolutely. Market cap is the total value. The metric that matters here is market depth, the capital you need to move the price by just 1%. And if the supply is locked up, that depth is razor thin.
So how thin are we talking? What's the breaking point for the global market?
Well, analysis of the major global order books suggests that the 1% market depth, that's the sell wall closest to the current price, it usually fluctuates between $100 million and $300 million. Let's be generous and take the high end, $300 million.
And our daily inflow is 310 million. It's mathematically larger than the entire global 1% depth.
Yes. The structural conclusion is unavoidable. The sustained $310 million daily inflow exceeds even the most generous estimate of that depth. The Bitcoin market is, and I'm quoting here, structurally incapable of absorbing this flow without violent upward price repricing.
Let's just detail that price friction so people can really feel the mechanic here. If the entire global depth is only, say, 250 million on a given day, what happens when that $310 million buy order hits?
The matching engine just X'd. It instantaneously eats the entire wall of sell orders at that price level. The depth is gone. And the remaining capital, that $60 million surplus, is instantly forced to sweep up higher and higher limit orders resting on the books.
So the price isn't gently moving up 1%. It's jumping multiple price levels. It's a vertical price candle. It has to, just to find anyone who is willing to sell.
And this is the core of what they call the crypto multiplier theory. Because the supply is fixed, that marginal trade, that last dollar spent, reprices the entire existing stock of 19.9 million coins.
So why does a $1 inflow result in more than a $1 market cap increase? This is crucial for understanding those big forecasts.
Think of it like a pond. If you throw a pebble in a huge lake, the water level doesn't really change. But if you throw that same pebble into a small, rigid container, our constrained supply, the water level rises dramatically. The multiplier just captures that leverage. And institutional analysis from firms like Bank of America and CoinShares, they all use different liquidity assumptions to figure out what that multiplier could be.
So if the market's deep and liquid, the multiplier is low, maybe 10x. But if it's hyper illiquid or sellers just disappear, that multiplier can spike dramatically.
Precisely. And that framework allows us to forecast the lottery shock with, well, surprising precision, depending on how stable you think the market will be.
This raises the critical question then. What does this inevitable friction actually mean for the price? We have to look at the three scenarios the sources modeled, applying that $113 billion flow to those institutional multiplier frameworks.
So what does this all mean for the price?
Let's start with scenario A, the conservative model. This uses a 10x multiplier, the one you often see in Quain shares analysis. It assumes a pretty liquid market where big sellers are actively trying to dampen volatility.
Okay, so this is the best case scenario for stability. Even in this most stable, most orderly world, the outcome is immense. 113.3 billion times 10 gives you a $1.13 trillion increase in market cap. Starting
from that $90,000 baseline, the projected price rises to about $147,000 per Bitcoin in the first year.
That's a 63% annual return. Just think about that. A 63% return is the most stable outcome, driven entirely by U.S. lottery players changing their habits. It just confirms how disruptive this flow is.
Okay, now for scenario B, the base case. This one uses a 25x multiplier, and this is the model that reflects what we've actually seen, right? The supply shock dynamics we saw after the spot ETFs launched.
Right. This model aligns with analysis from JMP Securities and on-chain data. It assumes the lottery players are sticky holders. They buy and they don't sell easily, which, fits their psychology perfectly.
So the math.
113.3 billion times 25. That equals a $2.83 trillion increase in market cap.
2.83 trillion added on top. The projected price here rises significantly, hitting around $233,000 per BTC.
That's a near tripling of the price. In this scenario, that daily tsunami of 310 million just overwhelms the institutional OTC desks. They can't absorb that much demand without running out of inventory, which forces them to bid up the price on public markets.
And finally, the big one. Scenario C, the liquidity crisis. This uses the extreme 118x multiplier modeled by Bank of America. We need to explain why this number is so aggressive.
The 118x multiplier represents a hypothetical hyper-illiquidity event. It assumes existing holders are almost entirely unwilling to sell. Not at current prices, not at near-term prices. For every dollar that comes in, the price has to just rocket upwards to convince one marginal HO dealer to part with their coins. The market essentially seizes up.
And the math on that is?
113.3 billion times 118. It's a stunning $13.37 trillion increase in market cap.
If you add that to the baseline valuation, the total market cap goes over $15 trillion.
Which means the projected price rises towards an astonishing $765,000 per BTC.
And this is the asymmetric shock we talked about at the top.
Yeah.
In this scenario, just U.S. retail flows alone cause Bitcoin to flip gold's market cap, which is right around $15 trillion. And it happens in a single year. It just highlights the fragility of price discovery when massive inelastic demand meets perfectly inelastic supply.
The math dictates violence.
Okay, let's unpack the quality of this capital. The $310 million quantity is one thing, but the psychology behind the lottery buyer is what makes this flow so uniquely powerful for accumulation.
What's fascinating here is the profile of what we can call the lottery investor. We know lottery spending is regressive and inelastic, right? It disproportionately affects lower-income households. The sources even call it a voluntary regressive tax.
Which means these buyers are already operating with a very specific, high-risk psychology that's actually perfect for long-term Bitcoin holding. They're not risk-averse bond buyers.
Not at all. They're accustomed to budgeting for a 100% loss. They treat the ticket as a binary bet. It's either millions or it's zero. And that binary bet psychology, it translates almost perfectly into the diamond hand factor that you see in crypto communities.
So if you're used to accepting a total loss, then a 10 or 20% drop in Bitcoin's price, which would cause an institution to panic and de-risk to them, it's trivial. They bought it for the moonshot anyway.
Exactly. They are fundamentally price insensitive once they're in. And this behavioral resilience makes them incredibly sticky holders, way stickier than institutional capital that's worried about quarterly reports. This stickiness is what supports those high multiplier scenarios because the supply constraint just gets tighter and tighter.
And we have to contrast the current state, which is wealth extraction, with the Bitcoin state, which is wealth retention.
Right. Currently, the aggregate player base loses about $43 billion a year. That money is just gone, transferred to the state. In the Bitcoin state, the entire $113 billion is retained on the populace's balance sheet, where it appreciates.
Let's go back to that base case scenario,
Yeah.
the $233,000 Bitcoin. In just 1 year, their initial $113 billion investment grows to about $293 billion in value.
This is a massive, rapid onset wealth effect, and it's concentrated precisely in the lower middle class, households that statistically have zero savings. The very act of converting a consumption habit into a savings habit creates this massive expanding balance sheet for the common person.
And this wouldn't be spread evenly across the country, would it? It would be driven by specific mega whale states.
The geographic concentration is key. You'd see these huge, continuous flows hitting U.S. exchanges from just 4 states. Florida with 9.4 billion, California with 9.3, Texas with 8.4, and New York with 8.2. These are like large investment firms making allocations every single day.
But the real data anomaly, the one that really tells the story, is Massachusetts.
Massachusetts is just fascinating. It has the highest per capita spending in the nation. $867 per person per year. It just highlights the depth of the habit or the hope. That cohort alone is over $6 billion in annual buying pressure.
$6 billion. From one state's scratch-off habit. That's equivalent to several mid-sized institutional ETFs combined. This suggests the just-in-USA impact would be kicked off by these intense, localized buying frenzies, creating huge regional wealth effects and a major headache for local governments.
And if we connect this capital rotation to the broader political and socioeconomic picture, we hit a fundamental conflict. It's a zero-sum game. While households get this accidental generational wealth transfer, the states face an immediate and massive fiscal crisis.
Let's talk about the upside for the people first. In that base case, we said their investment grows to nearly $300 billion in a year. How does that translate into real socioeconomic change?
It creates a ripple effect that's historic. You are providing liquidity and an appreciating asset to households that have always operated paycheck to paycheck. This instant balance sheet expansion could dramatically improve credit scores, provide collateral for loans, and potentially reduce long-term reliance on social safety nets. Because people finally have access to real wealth.
But their gain is an immediate, catastrophic loss for the public sector. State governments rely heavily on that $30 to $35 billion in annual lottery revenue to fund specific, non-discretionary things.
The sources outline a clear fiscal cliff. When $35 billion in what they call voluntary tax revenue just vanishes in a year, state budgets across the country are thrown into immediate, high-pressure deficits. This isn't a slow recession. This is an operational failure caused by a behavioral change.
Can you give some specific, tangible examples? Where does this money actually go? What gets cut?
Look at 2 critical examples. In Florida, lottery funds are specifically earmarked for the Bright Futures Scholarship Program. A sudden loss of $2.5 billion a year jeopardizes higher education for thousands of students. Or in Pennsylvania, the lottery constitutionally funds vital senior citizen programs, tax rebates, subsidized transit. That's a guaranteed loss of $1.5 billion for essential services.
And just imagine the political fallout. Imagine the backlash when those services are cut, all because the working class decided to save their money instead of gambling it away.
The crisis gets even worse in smaller states, places like West Virginia or Rhode Island, where lottery revenue is like 3 to 7% of their total state tax revenue. For them, this shock is a genuine catastrophe. They can't absorb a hit like that.
The state's reaction is where the policy irony becomes just profound. If $35 billion disappears, they are legally required to find that money somewhere else, usually by raising taxes.
They'd be forced to raise sales tax, property tax, state income tax to fill that budget hole. This just shifts the financial burden from the voluntary gamblers who are now accruing wealth in Bitcoin to the general, stable taxpayer.
So the very people who were disciplined enough to stop gambling and start saving are now going to get hit with higher property taxes to cover the shortfall that was caused by their own prudent saving. That is the ultimate irony.
And on top of that, there's the capital gains mismatch. The government will eventually get massive tax revenue from all this profit, right? Trillions in potential taxable gains.
So why are they still facing a crisis if they're going to make money in the long run?
It's the liquidity gap. Lottery revenue is immediate. It's collected daily, used for next quarter's budget. But capital gains revenue is deferred. The lottery Furdo dealer might not sell for years. This timing mismatch, immediate revenue loss versus deferred revenue gain, creates an acute, immediate fiscal hole. The schools and senior services can't wait 5 years for that tax money to come in.
Here's where it gets really interesting for me, moving from the fiscal side to the actual mechanics of price. Since this flow is strictly U.S. dollars hitting U.S. banks, it creates this localized shockwave. It functionally isolates the U.S. price.
The initial demand shock is localized, absolutely.
Yeah.
310 million a day from U.S. checking accounts hitting U.S.-centric exchanges like Coinbase, Cash App, Strike. This is the mechanism that creates the famous Coinbase premium.
We've seen that before, right? Where during intense U.S. retail buying, the BTC USD price on Coinbase trades higher than the global BTC USDT price.
That disparity wouldn't be fleeting, though. It would become persistent under this kind of pressure. The 310 million daily bid on the BTC USD pair is so aggressive that the price would decouple, maybe trading 1 to 5% higher than the global average. You would literally see a Bitcoin price just in USA, 235,000 in New York versus 230 in Tokyo.
But Bitcoin's a global asset. That premium is a magnet for arbitrage. It wouldn't last.
Exactly. Market makers detect that spread instantly. Their job is to exploit it. They buy cheaper Bitcoin globally and immediately sell it into that sustained, high-priced U.S. bid. This is how you export inflation.
So the U.S. populace, driven by their lottery habits, basically acts as a massive financial black hole, sucking in the global liquid supply of Bitcoin.
And the strategic outcome is clear. A massive net inflow of BTC into the USA. The U.S. working class, through this one shift, would rapidly accumulate a dominant percentage of the global circulating supply. They would be effectively cornering the market on the premier digital collateral.
And we can't forget the role of the institutional buffer, the OTC desks. They exist to provide liquidity and prevent retail demand from violently moving public prices.
But a persistent $310 million daily retail bid would drain those OTC desk inventories within weeks. They are a buffer, but they can't replenish their supply fast enough. They're designed to smooth out spikes, not absorb a tidal wave.
And once those desks run dry, the buffer is just gone.
Completely gone. Empty OTC desks are forced to go buy on public spot markets to replenish. This removes the barrier between retail demand and price discovery, leading directly to those vertical price candles we talked about, where prices just move violently higher.
The sources quantify it perfectly. The 310 million daily lottery inflow is 1.5 times larger than the global 1% depth. Mechanically, the price has to rise by more than 1% every single day until massive new sell orders show up. That mechanical necessity is the core takeaway.
So the ultimate conclusion here is just this profound conflict. We're looking at a scenario of extreme financial asymmetry driven by a simple retail behavior change.
You have the price asymmetry. The small, brittle Bitcoin market is fundamentally unprepared for a $113 billion annual shock. Even the most conservative models point to a price floor over $140,000.
And the wealth asymmetry, the just-in-USA nature of the flow, means the U.S. working class would execute a historic transfer of ownership, potentially controlling a supermajority of the global supply in just a few years.
But that all collides with fiscal asymmetry. The U.S. public sector faces immediate insolvency and critical budgets, while the private sector, the households, experience this massive volatile balance sheet expansion.
The entire system of the idiot tax gets demonetized, and at the same time, Bitcoin is remonetized at a gold-level valuation, all driven by this one specific retail shift. It's a truly inspiring and disruptive vision of bottom-up wealth creation.
So let's circle back to our call to action. We encourage you to try the alternating habit. If you have to have that thrill, buy a lottery ticket one week, but the next week, use Cash App or Strike to buy a small, consistent amount of Bitcoin. And just compare which bet yields more money over time. We think the results will speak for themselves almost immediately.
And here's a provocative closing thought to chew on. If this shock actually happened and states realized they had inadvertently transferred trillions in wealth to their citizens, how long would it take before those same governments, facing insolvency, desperate to get a stake in the wealth they lost, started offering Bitcoin-backed bonds? Or maybe even launching their own state-run Bitcoin savings plans?
Wow, so the state could transition from being a lottery operator and extractor of capital to a market maker for citizen savings. That would be the final, ultimate irony of the whole thing.
We want to remind our listeners that the content we create here is fully open source. We synthesize your sources from all over the web to learn and frame the original content for this show.
And we invite you, the listeners, to share more sources in the comments or critique our models if you feel our analysis is even a tiny bit off base. The goal is always to have a true symbiosis of artificial and natural intelligence to refine all this.
And yes, we're always looking for human collaborators who could review and critique our content before we publish. So please drop a comment if you want to help us refine these deep dives.
As always, keep searching, keep the quest on.